Recording is on.
So, welcome everyone to the first Bonding Curves hangout or meeting, which we do publicly. And I initiated this because I really like this area of research and the different people who are proposing ideas around this. And I think that it can become a very important part of blockchain technology, especially smart contract designs, together with tokens and different token economics, and how people in the future will not only, hello, welcome, how people in the future will not only make, let's say, curation of content, but also that it can be used for a smarter way of funding a project in the future. Whom of you know the basic concepts of bonding curves? Josh, please.
It is a discrete input to output matching mechanism.
Yes, my question was more in the direction of should we, should someone of us summarize it one more time from his perspective or her perspective?
That's a good idea. Briefly, just for the recording, if it's going to be shared.
Yes. Okay, then I will try to put my point of view, and maybe afterwards another person could also speak for 2 minutes and explain their point of view or agree or disagree with me. I will try to make the moderation, so when you want to speak, in the left corner there is like a hand. You can click the hand, then I will see that you want to speak, and I will try to moderate it so we don't speak all at the same time. So for me, I try to make it LE5 because I think it's very important that we are that you understand the basic idea behind bonding curves. So for me, a bonding curve is a smart contract, first of all, and this smart contract is you can send tokens to the smart contract, for example, one AE token, and you could get in return project tokens. Let's call them the bonding or the Emin, my name is the Emin tokens. And the idea is that the tokens I received, if I make I sent one AE token and I received 100 Emin tokens, I can send back 100 Emin tokens to the smart contract and receive back my one AE token, which I sent in there. But not one-to-one, but in a curve. So in a curve, simply said, is if I send one AE token into the smart contract, and let's say I receive in return 100 Emin tokens, and then a person after me is following, and they send in one AE token, they might receive only 99 tokens out. And based on how many, if more people get interested and more tokens get created, so let's say 2 people have participated, obviously 199 Emin token exist in this point of time. As more tokens are getting created, as more expensive it becomes to buy tokens, as less tokens you get for sending in one AE. And in the same way, if I'm like an early participant in this bonding curve, I can, at a later stage, send back my Emin tokens into the smart contract and receive AE with profit because it already got more expensive. Or I can decide to take my Emin tokens and sell them somewhere on the secondary market for a higher price than I bought them initially. And what amazes me in this very, very simple way of created a bonding, a token minting through a bonding curve is that you always have instant liquidity to also send back your project tokens, and with this also signal that you don't want or don't support or don't believe in this thing anymore, and you can basically receive back the deposit that you made. Maybe somebody else wants to explain it from his view or her view to make this simpler, but this was the basics, what started to interest me in this concept. Moritz, maybe you also want to say a few words, or somebody else?
If it's useful, there's a diagram.
It helps a lot. What you have drawn there is also interesting. So you have drawn one curve for buying and another curve for selling tokens. This is a mechanism, I think, also very important. So for example, you could say, if I buy if I send one AE token into the smart contract and I receive 100 project tokens back, and it immediately send them back into the smart contract, I receive less tokens, less AE back from the initial what I sent into the contract. This is a way how you could incentivize early adopters or take care that they will not immediately dump or sell back their tokens into the contract, but stay longer because they have to wait longer and for more people to follow them until they can sell it back without a loss or sell it back with a profit. It would be super interesting to hear some questions or get some opinions from other people here. Thank you for showing the graph. I think it was very helpful.
Most welcome. I do have a question. I was pretty much hit upon yesterday with some tough ones. How do we make sure that early or that later contributors are not necessarily funding the early adopters? So this was one of our community members actually that was on to us about that, and I'm slightly puzzled by it. So the early contributors, they contribute, and after that other people buy into the curve. How does that work as a safe mechanism? I'm still struggling with his questions that he got me with the other day, but I can see the reserve pool fluctuating, which might make it safer, but other than that, I'm uncertain.
Somebody wants to answer, or should I?
I could answer it, Helmut.
That'd be great.
Well, in a certain way, that's exactly what's happening, but it's not a bad thing because, for people who are investing very early on in a project, they face a very high uncertainty. Yeah, whether kind of the promises work out, whether kind of, they will find users and so on. So basically, they have a much higher risk to invest, which also means, kind of, let's say they face a chance of success of 10%. So if they, for their 100, for the one Ether or for one AE, receive 100 tokens, then kind of what they really receive, because the chance for success is only 10%, they really only receive 10 tokens, kind of on what an expected kind of, like how much can they expect in the end. If you are much later on in the project and you see kind of that the success chance is high, they got some users, their business plan is working out and so on, you might receive, like, invest one Ether, and receive maybe only back 10, or let's say you receive only back 20, but the success chance by then should also be already much higher, say 50% already. So though you kind of receive less tokens for the same kind of money that you paid in, you, on an expected level, you receive the same amount of tokens.
Yes, I think I understand. You're stating the risk is reduced.
Exactly. Yeah. Basically, the risk is reduced. So I think when you look at any venture capital funding or any kind of early project funding, it is because of the high uncertainty it is it receive like you receive a higher amount of tokens just because you don't know if those tokens are in the end really worth something, or at this point in time they're just worth less. And this is why the secondary market is this is kind of the nice thing about the secondary market, because you always have also a real price of the token.
Yes, the arbitrage.
I would also like to add, I think that, I mean, within this is a lot of game theory and like how markets work or supposed to work. And I mean, yes. So let's say I'm somebody who got in early and is kind of showing my support. So showing, let's say the tokens at the beginning are basically worth nothing, right? So I sent in 1 AE, this is 40 cents right now. I receive whatever hundreds of project tokens out of this. But I really, really believe into whatever I am supporting there right now. So who else should early on acquire project tokens? So for example, the project initiators themselves. So think about a team of 10 people that are going to start a venture, and they're setting up a bonding curve. And then those 10 people, they just are like early in buying into their own project token and bonding curve. So they are the first ones. And then those 10 people, they got for a little investment, they got a lot of the project tokens. Now they go out and promote the project and try to find people that also like it and support them. Of course, it will not completely, it will, like, whatever you do, you will have problems. And I think this was also like your question is, how do we protect ourselves from people who scam or do like a Ponzi scheme or try to trick the system? And I think this is not solved yet. But at the same time, I believe that the way to actually be able to not that you don't need to find a decentralized exchange or whatever to take your tokens, list them, have some liquidity, being able to do something with it, but actually being able at any time to take those tokens and send them back and get your deposit back, basically. It gives you as a supporter a total different way of interacting with projects. And I think, yeah, and I think like this 2 different curves that you showed are also a big help. So you could say if somebody buys in early, they need to stick for at least like 1,000 more people to come after them until they can sell back their tokens without loss. But Moritz would like to add something here. Moritz?
Yes, hello. I think what's also important to mention is, or maybe what people mistake bonding costs for, is Ponzi schemes. So they think, obviously there are Ponzi schemes, so they only work when people coming after you, they support the people who invested before. But I think the difference with bonding curves is that there is actually an intrinsic value. So the tokens or whatever you are selling, they are supposed to have some future cash flow, something that makes it worth investing in the beginning. So the people who invest in it early, they believe that the project will do something meaningful, and in the end, they can probably cash them out. And so there is some value inside it. And actually, another mechanism that could be used to reduce the risk. There's also an interesting article on that, is short selling. So there are also actually some ideas to short sell on bonding curves. So if like an asset would or a token would rise really, really high, then people could see that, okay, there's maybe something wrong, so I bet against it, and so you could use short selling for that, for example.
This sounds really interesting. Can everyone who is in the call here and who have read interesting articles, maybe just post the link into the forum where I started this thread to call for feedback. This would be super great, because I think reading material is. I already started with 3. I posted here in the Jitsi chat too. Yeah. So do you think, maybe I would like to raise a question. Do you think this like bonding curves or like doing token sales through bonding curves could be an alternative or a future that could replace how people did initial coin offerings on Ethereum back in 2017? What is your opinion to this?
I mean, the difficulty is, especially kind of if no future, if no cash flows are in there, like it's really how are you going to value a certain project? And I mean, at the moment, kind of you like how it's happening is like you get all the money or all the investment upfront, and then you hope, and then kind of you try or you accomplish kind of what you promised till kind of the financing runs out. And ideally, kind of you should have received at the beginning as much as you need to accomplish the vision that you promised. Yeah, say a deal case. Now imagine kind of you start in, you have a certain vision, and you actually deliver all the milestones. So same as in case one, but the sentiment shifts. I don't know, crypto winter starts, or just whatever sentiment shifts. It immediately kind of leads to the situation that people are like don't want to spend so much in the secondary market on your token, and then you can't get additional funding. It's a little. I mean, it's problematic, but on the other hand, it's like in real life. I mean, there's so many startups who didn't get it, like a Series B, Series C funding and had to close down. I'm just saying, it's if you don't have any cash flows, it is much more difficult to value companies. And without this additional valuation, where you say, oh, it's at least worth this much, then kind of the current sentiment is so much more important and so much more volatile. And this is when it can become problematic.
If I can add additional just a thought on this.
Yes, please.
This is replicating exactly the early stage startup market from all of the. I mean, they have exactly the same issues. The volatility not as pronounced as in crypto markets, but also they also have some sort of volatility. So basically, what drives the market here and the investment here is that the best 10% of the projects and startups are always financed, regardless of what's happening to the market. I guess because of the, signaling to the market itself that these are the leaders, and if their investment is safe. The problem goes where you have mixed signals. So whenever you're ready to fundraise, let's say Series B, if you have all the numbers behind you and trajectories behind you, the rounds is always oversubscribed, never undersubscribed, regardless of what happens, even during severe market crashes. So I guess, what I'm trying to say is that, if you look at the 100% of the market, that is true, but usually the 10% of the best ones circumvent this issue, regardless of the crypto winter or the recession or something like this. And I think bonding curves just prevent, let's say, unwanted liquidity or dumps that exist in the crypto markets in the last couple of years. And I think it's a very good future for what's coming in the next years, in combination with some other methods and techniques.
Yes, please, Helmut.
Yeah. Well, but there is though kind of a slight difference. Yeah. One thing I pointed out is in the end cash flow and how do you value crypto companies. But the second thing is, because you have on startups, many early investors, when they invest and the second round is coming up, people from the first round are not allowed to sell their stuff, just because often it can be much easier to kind of do the first steps, but then later on the scaling becomes more difficult. You want kind of people to stay longer on board. So kind of that there is a secondary market is actually not how how VCs work. You know, they say, hey, kind of, we want to put additional money in, but on the other hand, you know, sorry, I contradict myself. That's actually not true, because they put actual additional money because it's cheaper to buy from the primary market. So they put
and also, and also the logic is, if we're taking the correlation from the startups, it's actually the correlation. So VCs sometimes encourage the founders, the original token holders, whatever you want to call them, to liquidate portion of their funds so they can get their life in order, so they can have a stable life and focus on growing the company and not surviving itself. So not everything, but a certain amount of tokens or certain amount of equity is sold in, let's say, the first significant round, Series A, for example. So this is not an uncommon thing in the VC world. So it is kind of an incentivization scheme at the same time, which contradicts the bonding curve mechanism.
Helmut, do you want to say something to this, or?
Yeah. So the last company I worked for, we actually grow from zero to an IPO. It's true, so that sometimes founders are allowed kind of to sell a certain stake, but usually this is really very much down the line that they're allowed to sell anything. But really, kind of in the end, kind of if there's additional money flowing into the project because they perform well and their kind of curve is cheaper than the secondary market curve. I think kind of the funding part should be mostly fine. It's really kind of then comes down to valuation, whether kind of those companies can be properly evaluated, and if no, you will just have, like, just as we see in crypto market, just very high fluctuations, even in very good and performing projects, because you don't know how to put a price tag on the token.
Moritz, you want to add something here?
Yeah, I think it's especially interesting that it could be like a continuous market. So you could have the bonding curve the whole time, and it's so liquid, people can always sell their assets if they think that the project is going into the wrong direction. So you could have like a continuous funding period, and I think this is very interesting because people can then, if they think, hey, I invested some token in there, but I don't think this project is on track, so I want to sell my tokens in that project. And I think that's a very interesting attribute that nowadays you can't really do. You have to wait until the project is bigger and you can sell the token on a secondary market.
Yeah, and also secondary markets are not necessarily liquid, and I think that this is so. I think that we have mentioned a few mechanisms already here in this round. One was having a buy curve and a sell curve, which is kind of making it unattractive to immediately sell it back into the curve. The other thing that was mentioned is the short selling, for example, things like happening there. And also what Moritz has just mentioned, that it can be a continuous minting of tokens. I think this is also that many people here understood. And I think what we'd like to try to find out is also, or like what me interests, my personal interest here is, if we can use as a special kind of a bonding curve and to find a way for a sustainable funding at the start, maybe software projects, where you have not only, where the token is not only has a value in terms of I can sell it back into the curve and with profit because people after me bought some stuff, but maybe this token has also a real utility. So in a software project, this utility could be used, for example, to place a signal of vote for specific tasks which are in the backlog of a software project. So let's say as an example, it's just a thought experiment, right? So as an example, let's take an SDK, and you run a business, and this business is using free open source software, and you are using that SDK. Now you face problems in your own business because there is a bug or there are features missing in the SDK. And let's say, just theoretically, we have a token curated registry or list where people could, where I as a business could go to the bonding curve, buy tokens, and then stake them on a specific task in the backlog of a software project to signal that this is something very important for me, and I would like to prioritize it so I can do my business better. So I think bonding curves can not only be there, like could, in a combination with a utility and other things, could incentivize people to, or like maybe we could find a method, and I'm not the only one thinking about this, another person told me, I'm telling you now, is to find really ways how we can also sustainable finance open source software projects or other things if everything goes as planned. I just want to throw this in because I think it's a very interesting and nice example. Do we have some, Moritz, you just recently wrote a blog article. Would you like to share this and say a few words about your idea behind it?
Sure. I can send the link here in the chat. Yeah, but the idea was basically, actually I had this idea even before I heard about bonding curves, or at least I knew the names. But the mechanism kind of works like a bonding curve, so that you have an automatic market maker. And the idea is, and this article is called curve bonded derivatives. So the idea is to have derivatives. So meaning that you don't have don't have a tokenized asset that you're doing the bonding curve with, but you actually just have you're investing in a derivative. So the idea is to use, or I suggested to use something like URLs as unique identifiers for these derivatives, and then people could invest bonded into this URLs as kind of a derivative. So so the idea would be that you could actually invest in everything. So everything that can be represented by URL could be made investable. So for example, if I would like to invest in Drake because I think, hey, Drake will be more relevant in the future than he is now, then I could invest tokens into the URL, maybe drake.com, and the idea is that basically there's no real connection to a performance indicator like normal derivatives would have, but the connection would be more like you have a collectible or a trading card. So you would own something like you would own a Drake trading card, and then if Drake rises more in value and will become the most famous star in the world, then the idea is that also the relevance of or more people have demand of buying tokens of this URL, and this would signal that it's more valuable, and basically would be a kind of an information market where people could bet on if something will have more value in the future than it has now. That's kind of basically the idea. It sounds maybe a little bit abstract now.
No, not at all. I think having the card game, like as an example, I think I like this. I mean, I think I understand this and like the idea a lot. I would like to see it, of course, built soon, so we can play around with it and see if the market works. Does anyone has a question to what Mo has just presented? Maybe this is the right time to ask. Does everybody know what a derivative is? I guess.
Or does anybody not know what it is?
Oh, please explain. Usually people don't know it.
So basically, it's you can use a financial instrument to invest into something else. Like in my case, it's not really it's not like you have actually stock options that entitle you for earnings, but that you invest into something that is connected to, for example, the stock price. And if the stock price then rises, you will get also something back. So there's not a there. So there's like kind of a different connection to normally a real financial asset. I don't know. Somebody else wants to explain it better, maybe.
No, I think it's.
No, I mean, a stock option, for example, yeah, is a derivative, yeah, because a stock option has, let's say, the base price is 100, and when the stock rises over 100, then kind of you can get, let's say, to 110, then you get 10, the difference. And if it's below, well, then kind of then because it's a special kind of derivative, you're not kind of activating it, and then you don't get anything, but you don't pay anything except what you paid for getting this derivative. And because you can basically make up these derivatives as you like, as long as you can find someone to buy it, there is kind of really an insane amount of derivatives. So the derivative market, I don't know, like, tell me if I'm wrong, it's like 10 times bigger than the entire kind of global domestic products.
Thank you for the feedback, but I think it also goes a little bit too deep into like the financial world, and I would like to basically bring back the discussion to also a little bit to the technical implementation of how something like this could look like. And I think things that we could try, if you are interested, is to come up with some, interesting. So Leo asked from China, he asked, if there's an example already, and if there are some recommended parameters for it. And I think it would be interesting to kind of have a simply specified sample contract that we can interact with, where we can maybe do something like Moritz showed, like with a basically trading cards based on unique identifiers, which are URLs, which again basically represent the underlying thing. I think this would be an extremely interesting little project, and we could play around with different kind of curves. Like a curve could be linear, it could be an exponential curve, it could be all kind of curves you can represent in such a bonding curve smart contract. So then, just to repeat it one more time, you have a curve which defines how many tokens you get for, let's say, one AE that you send in. And then there's a second curve that defines how many AE you get back when you sell back in your tokens. And I think this also combined with a very basic and simple front end could end up in a nice game. And if you see like participants, even if it's just 50 people or 100 people, and we see that the market dynamics are kind of working and are interesting, I think we could explore this more for the future also of token sales and speak about this. But I would really like to see like some technical implementations of it, and maybe also for the next week or the week after. I still need to check when we could do the next round. We could try to invite people who have already written some contracts. And I have one team which also contacted us a couple of weeks ago. Maybe people can also look into their products. I think it's super interesting. They also made an improvement proposal on Ethereum, I think, and maybe we can get those people to make a presentation for us. I just quickly check their name. Convert again. What was? Give me 1 second. I will have it for you guys in a moment. Ah, yeah. Okay, I will post it in this into our chat. This is the team. So I will maybe ask them if they are interested in joining us in this call and maybe presenting their work and what they are currently work on. Oh, it's not working with 1 second. This is the link which is working. I will also share all the links and notes in the forum. And yeah, are there like some other topics or questions on your side, Moritz?
I just, again, if somebody has questions, because I would like to take the opportunity to the, which I now briefly presented, but does anybody have an opinion on what I just briefly presented?
So for me, it's interesting how to get like a critical, like always like a critical mass that people, if people understand the concept of buying, let's say, tokens from an URL which represents something. So it could be apple.com, and I'm a big fan of the new iPad or whatever. So I'm basically go there and I invest into it. But I think what I'm missing a little bit and what I didn't understand is like, what is the value of those signals? Is it really only that I'm kind of that I did an early discovery and bought in early? So is it curation basically, or does it? How do you think can the mechanic work that you get people to participate in it?
So I mean, basically, it's just a bet that people think if something will increase in relevance in the future or if it won't increase in the future. So I think this is a signal that you can send. So for example, I don't know if I wrote now this article and people think, and I probably think, hey, that's a very good article. So I put some money inside it because I think it will increase in the future. Maybe other people think that too, and so they also put some money inside it. And then maybe at some point people think, oh, okay, this is not going to grow anymore, so the relevancy for this is over already, so I sell my tokens in it. I don't think about it. And so I think that's how basically it could work. And you could use that, for example, for crowdfunding. So if you have a nice idea for a project, I don't know, you could write it down, make just a very short description on it on GitHub, or write an article about it, and then stake yourself tokens. I know, maybe 2,000 ESA or whatever, like a lot of tokens if you believe that it's worth a lot. And then if other people also think, hey, yeah, that's really, really cool, I also put money inside it, and they all could also stake more and more tokens inside it, and then the tokens that you put in first, you could easily sell. And so it would also not be like very, very difficult to set this thing up. So you could make a very, very easy crowdfunding mechanism. And that's for one example where I think it could be very interesting.
Is there any value to the tokens except of the speculation that people will follow you and buy after you?
No, there's no value. The only difference is that to a Ponzi scheme or to a pyramid scheme is that that you have this connection to really something like a URL, so, or like a real entity. So you have the bet for that. So you have to basically, I think the only good analogy that you could give is the one of a trading card or collectible card, where you also, it doesn't really have, the card itself doesn't have any value. But I mean, money itself also doesn't have any value. It's just a social construct, how we communicate. And so I think that probably in the future won't be, or I mean, at least is something interesting to explore.
So I'm asking because if you look at the mechanics from, I know two companies, for example, that use bonding costs already, or like that plan to use them. One is, for example, Zap.org. They make an Oracle marketplace. So basically, they have people who register an Oracle there and serve data that you need and that you could query and get information. This Oracle could be an Oracle for the results of a football game. So now if I'm an early investor, or if I do curation, I basically go there and I think, oh yeah, I see this oracle that is providing the football results. So I'm going to buy into that oracle early. And what I'm buying are that let's say one token represents one request to that oracle. So if this oracle gets if there is getting a huge demand for this oracle, I can then basically sell my tokens, because people who are buying those tokens are people who are requesting answers from this oracle. I like this mechanic because it is giving you not only this kind of curation, it is also giving you the utility for like this toll API querying the oracle and getting something back from it. The second thing I know, which I also like, I think it's Ocean Protocol. Ocean Protocol, I don't know what their domain is. Let me quickly check this. So what they are doing is they make a data marketplace, and they have basically the same incentivization. So what they do is they want to have people that sell their data. It could be data to train an AI, for example. And to discover which data is interesting and good, they basically tell investors or people to buy into a bonding curve, signal that this data is special, and when then other people discover this data too and want to consume the data, they will need tokens of that data package to consume it. It could also be used for, let's say, discovery, like you see a video on YouTube and you think, wow, this will go viral. So you basically buy into this video, and then people who want to watch the video later on, because it goes viral, need to buy those tokens from you, also need to buy tokens out of this bonding curve. But it's just, I mean, it's just like what my head is thinking when it comes to tokens and their utility too. Hello, Emil. But I think, Moritz, I think your idea can work. I think it's great. Helmut, did you understood Moritz's idea? What he's trying to do?
Not really.
So yeah, Moritz, you have to explain it better.
Yeah.
Should I try it one more time with my words?
Yeah, maybe you can try it.
So Helmut, listen, come on. I mean, it's so important that I think we try to understand where coming on one page in order to have like a good discussion about what could be done. So what Moritz proposed in his blog post is that if you could invest in something which has a unique identifier, so let's say, and he choose URLs. So it could be apple.com, or it could be a musician, Drake, or it could be, I don't know, any URL, even google.com. So now what you could do is you could basically into a bonded curve buy tokens from that URL. This will only, if I'm the only one who bought into this URL, or who said, hey, I'm staking, or I'm sending a few tokens and I get back like the google.com tokens, I kind of show that I have discovered this URL or this website, and I kind of own it because I'm the only one who has tokens from that. So it's like owning a special trading card from google.com. And then other people who come after me and also think, wow, this will get traction and this has value, could do the same thing and follow me. And I could potentially in the future then sell my nice discovery with a profit. I think this makes more sense with like upcoming artists or musicians or things like that. And it's also not connected to a real value underneath. So it's basically just a representation of something And Moritz just proposed to make like a playful market around this, so you could basically invest into any URL in the internet and see if you make like this type of derivatives around URLs, which again represent a company or an artist or a project.
Yeah, but I mean, the thing is just on like people, buy or invest, like maybe I'm like not enough in the art world, but people invest and buy in derivatives or in something because they try to make money out of this, yeah, and others because it's a sort of insurance. I wonder, like, I mean, I see kind of the thing as a collectible, but yeah, it would be then a collectible sort of.
It would be sort of a collectible, but the person who is like who first discovers it or thinks that it should be more valuable than it is, they can buy into it. Like you would say, hey, I think this trading card of, I don't know, Michael Jordan will increase in the future, so I buy this trading card now and then I can sell it later for profit. But if you are wrong and Michael Jordan, I don't know, will be forgotten soon, somebody else will come, then you made a loss. And so this mechanism I would use, but for everything. Like it could be an article, so I'd register the article, or it could be a pop star, or it could be a book, or it could be whatever, everything that you can represent with an URL.
Yeah. I like. I mean, yeah. I just don't see like how like why would I do it? I mean, what's like the thing is, like, even with the trading cards, I mean, the trading cards, like, it sometimes feels people do it because other people do it, and maybe that's why kind of it's difficult for me still like to imagine this. And in addition, kind of those trading cards you can show to someone and say, look, I have trading cards, and you don't, and they're old and their history, and there's most of the like ones that are worth something, they're old, and that's what people like, to have something of history and be part of it. Or
I understand what you mean, but imagine this, for example, that I think I had this feeling a lot of times that you discovered something new, like, right? Like when I was younger, it was more exciting that I discovered a new rap artist, or I don't know, when the Antwort came out, was like mind-blowing. I thought, wow, what the fuck is this? And so if there would be now a mechanism where you can think, hey, okay, I buy into that, I will think in the future this will be more relevant. More people will see it and will find it interesting. And if I am the one who has a stake in that, then I can sell it later for a profit.
I mean, what would be nice out of it, why people would do it? Because first they could say, yes, I'm the first one, but in general they would also use it to discover maybe artists or something like that.
Exactly. Yeah.
Exactly said. So if let's say Universal is signing a new artist or so, what they could also do is they could be the first one staking a lot of funds into this artist, just to make him like that other people discover him, and other people could build, I don't know, top lists of what are the most interesting things that currently people put their tokens in, right? And what is new popping up. So I think if you have a front end that makes this accessible, where you can kind of see like, hey, I don't know, I start tomorrow and I will just go to my 10 most favorite artists and I will send 1 AE token and that's it, right? So, or even 0.1. And I can say, hi, I am the sole owner of this unique identifier. It could morph into a game, and at the end of the day, we are often talking so much about gaming theory or games theory that I think at the end of the day, this whole thing is a game anyways, like the whole market and everything. And if we can make it, or if Moritz, if you can make it possible that everyone can invest into everything, even if the token that they receive has really no utility and no value, it could still create, I think, or develop a value if this starts to getting fun for people to participate.
Yeah, I mean, I would be great like if somebody has some opinions on that or have any critical feedback, because obviously I'm looking for critical feedback to see what could I describe better, or maybe if I'm totally wrong could also be the case. So hit me up, or if you don't have anything now.
I'm happy to read it, and then kind of maybe we can talk about kind of more detail later on, because I think really even kind of, do I want to be the only one, and then like a lot of people like, or do I want kind of to make this a signaling mechanism on some platform where people can stake, and then if they're like one of the first ones, they get kind of cheaper tickets, or kind of the ticket prices that they had at the beginning, when they had their first concert, and you keep getting them, but then also signaling from them early on, costs really something. You really have to invest some tokens, or something like this. I think it could kind of then evolve into some really nice way of the signaling mechanism. But
I think they need, from my perspective, I would love to see some type of utility or landing page or something. I think on stuff like Hacker News, right? Where every day you have like people post articles and they kind of rank themselves, and I go there and I get quality content, and it's always like a place where I like to check it out. And I think if you're not only making it if you find a way to making this to gamify it in a way that people see that this token is like has some utility, and even if the utility is only a discovery of like that other people discover it after you, I think it is already something super interesting.
But I mean, look, you said something about the utility the token could have some utility. I own actually for a lot of money tokens who have like a utility that it allows me to use a certain service, and they build on top of the service, so enabling kind of additional functions. So kind of, I trade, so like a trading bot functionality and stuff. And I know there's kind of a limited amount of tokens. They have a good track record. So they give recommendations what to trade and how. And I'm thinking, okay, more and more people kind of will realize that that they can beat the market like a good fund or like a good fund, and then they will want to get tokens as well. And there can only be roughly 2,000 people with the same service level that I have. So kind of if more people find out about this, they're going to want to pay more into this, and then kind of
I like this too, but I think this is going too far away from Mahrdt's initial idea, because Mahrt is to really make this universal, right? It's like as universal as possible, and a utility is obviously not universal, it's very specific. So it already works, what I showed, I think it already works for data, so like zap.org or Ocean and so on, because that kind of makes sense, where you kind of pay per query, like this toll APIs. But I don't know, I think it, like you planned it, Moritz, it needs to have a front end, a user-facing front end where people get something out of participating in this market.
Yeah, I mean, obviously, like on the front end side, there could be done a lot. For example, you can just limit it to something just for musicians or something, and you have a web page just for rappers, and you can register a rapper, and you can see, I mean, whatever you do on the front end, I think there could be there would be potential for a lot of different stuff.
Maybe we can make you suggested it to me personally, but I think maybe it would be fun to, maybe not this weekend, but next weekend or so, where we can make really a little hackathon and try to come up with some simple contracts and interface. I think that would be absolutely great.
Yeah, nice. Let's do that. I think that's also very interesting.
Maybe Milan and Mio, maybe you're also interested to join. I just read Mio said here an Oracle-related app should be online soon. So nice. Leo is also did AE one of the blockchain explorers from Eternity. So yeah, that would be absolutely great. Maybe we can find a time and where we make a hackathon and play around with this.
Yeah, we can try that.
Cool. So we talked for 1 hour. I think this was a very, very nice first round. And I will try to prepare some agenda and some follow-up action points for this year. And then I will post it into the same forum post, and also change the time there. Yeah, I think this was very interesting and successful and cool, and we will next time make it more in the morning, so we can also have people like Leo from China participate more easily.
Yeah.
I would say we close it with this. I think 1 hour is enough, and I'm really looking forward to do this more often and again. Thank you, everyone, for participating.
Thanks.
Thank you for setting it up.
Of course, bye.
Bye. Thank you.
Bye.